So this is a question you should be able to do really easily because this is a basic thing you did in your accounting class and in your finance class, but we all do it a little bit differently. So you got to figure out your professor a little bit. I do it as a table first because I don't care about your calculators. You won't use them again. I don't like Bill Gates because it's a black box. I love the table because you see exactly what it's doing. You can also calculate duration using the table. So here we got the face is for saying $1,000. The coupon was given at 6.5%. The term, it's a 10-year bond, but 8 years ago. So what's the term? 2 years. Its rating is what? A plus. You don't care what it was rated. So the risk-free rate is going to be what? Yeah, 4.3%. So if it's a 2-year bond, use a 2-year treasury, right? You don't use a 10-year because it's not a 10-year bond anymore. What kind of yield curve is this? Is that normal? That's an inverted, right? The 10-year is lower than the 2. The spread, what's the spread?
115.
115. And so this is what Rob was talking about. You take 115, divide by 10,000, you get that spread. You should get really good at reading basis points just really fast. 115 basis points, that's 1.15%. You should just get really, really fast at that because we do that a lot. So that gives you the discount rate for the bond of 5.45%. We have to do the effective yield because coupons are paid twice a year. So we take 1 plus that divided by 2, raised to the second minus 1. We'll get a slightly higher yield. So if you want to do extra analysis, you could do a guess. The guess says minus duration times the change in yield. In this case, I'm going to guess the duration is 1.93, I guess. And so we got minus 1.93 times the current yield is 5.45%, the coupon. So interest rates have fallen, so the price should be higher than par. So it should be up 2%, so 1,000 times 1 plus 2%. So some of y'all are really close to that. I saw 1,019, I saw 1,020, so y'all are really close to that. That's the guess. Let's try the Bill Gates part. I never do, but minus present value times the rate is 545 divided by 2. Number of periods is 4 because it's 2 years, but it pays twice a year. It's going to pay how much? 325, 32.5. And what's the future value? $1,000. Does that look possible? That certainly looks possible. The sweet approach that I can never get right, but let's see, maybe I'll get it right this time. So we take 32.5 divided by the discount rate divided by 2. That's the value of that coupon for all of infinity. And then we're going to add to that $1,000 minus that. But we're going to divide that by 1 plus the rate divided by 2 raised to the 4th. Take those two together. Does that look close? There's the sweet approach. But what you have to do is the table. They're all looking pretty close. My guess is going to be maybe a little bit high. You would think it'd be low because of convexity, but my duration could be off. So we got the cash flow, we got time, the cash flow, discount factor. Discounted cash flow, and you don't have to calculate this, but I do like to calculate duration. So factor 1 divided by, here we use, the only place you use the effective yield is when you're doing the discount factor. raise the time. You should get 0.9 something. Discounted cash flow, just multiply across. And it should give you exact same answer as Bill Gates and Sweet, and it does. And the duration you don't need, but duration just time times each discounted cash flow divided by the price. So the actual duration is 1.91. I was kind of close. So, you are supposed to divide this by 1 plus the rate. And that's going to get you closer. That's the modified duration. But anyway, all three of them are giving us essentially 1,019. So I saw Team 6 look like they got it right. They got 1,01970. That's probably rounding, right? There's going to be some rounding issues because you're not going to have Excel to do this. I wish we could do it in Excel. So your other professors may not have you do this. They may be teaching you the calculator. Kind of the biggest waste of time is learning the calculator, but on an exam, it can be helpful to double check your work and make sure. If you get 1,01970 and you get 1,01964 in your calculator, you can be pretty sure it's right. If you get $813 on the table and get 1,019 on the calculator, there's probably some problem. You're going to have to go back and check. But that's how you value a bond. Very, very kind of basic skill of an accountant and a finance major both should be able to do this. Anybody in finance or accounting, if I threw this problem at them, they should be able to figure it out. They may not know how to do the table, but they should be able to figure out how to calculate the present value of a bond. So pretty straightforward stuff, pretty common. Any questions on that? All right. So last class, we're talking about valuing stocks. And so a stock, it's all about the growth in earnings. When you do paper 4, that's going to be your biggest issue. We said we have two growth rates we need to come up with, a long-term growth rate, which we're going to tie to what we think the economy is going to grow. It's probably going to be in that 4 to 6% range. We're getting an economic number this week, I think, or maybe next week. They're expecting it to be around 2.6%, but that's real GDP. That's what they report in the news. So you add 2%, 3% inflation to that, we're in that 4 to 6% range. So you're using nominal GDP, which includes inflation, but they report real GDP. And to be real careful on GDP, they usually announce the annualized number. I like to use the year-over-year change. They use the annualized number. That can be really tricky, especially during COVID. That annualized number for the second quarter is like negative 30-something%. It looks terrible because you annualize one bad quarter, but you assume it happens for an entire year. It's just terrible. The actual number is like negative 2 or 3%, so it wasn't nearly that bad. So when you look at these numbers, know how they're reported, how they're calculated, and realize the GDP number is revised many times and quite dramatically. That's one of the reasons you would think, wow, GDP's got to be one of those most important numbers, but it doesn't usually move markets because it's revised so much. People are like, it's hardly even a good estimate. It's revised so dramatically. But over the long term, once they finalize it, it's probably a decent number. There are people who think it's got some, there are some subjective things to it. We don't really trust China right now and what they're reporting on numbers. We think there may be some gaming going on numbers there. We know, I think it was Ethiopia that revised one part of their economy, and suddenly they went from being, I don't know, third or fourth largest economy, being the second largest economy, and they just like massively improved. So there are questions about that. So you can certainly debate that number, but historically there's been that close relationship between nominal GDP growth and corporate earnings growth. Remember that slide I showed you, nominal GDP growth has grown about 6.4%. Corporate earnings have grown about 6.1%. Pretty close tie. So we're going to start with that. The Motherin says use the 10-year treasury. So the 10-year treasury right now is at 4.3%. It's at the lower end, or no, I think today it shot up, didn't it? Where's the 10-year Treasury today? It shot up to 4.4 something. Yeah, we're up to 442. So we're about to hit 4.5% again. Oh, that's the 10-year, 4.43. Yeah, the yield curve steepening again. The 10's above the 2-year. That's pretty important, right? That gives you not a normal curve, but it's at least getting more normal. So 4.43. I don't know, my next buy point, my previous big buy point was 5%. So I was buying at 4 and 4.5 and then 5. So I haven't bought in quite a while. I might change my mind and buy it if we hit 4.5% because I think that's a pretty decent yield. I'm actually pull off some from stocks and increase my bond allocation. 4.5% on a risk-free rate is not bad. So I don't like using the 10-year Treasury. I like using our approach, but there's certainly that argument there. The other number you need is how they're going to grow today. So long-term is their terminal growth, that growth they're going to eventually get to, but what are they doing today? And I said there's several approaches there. Last class, we talked about the PEG ratio approach. So in our investment society meeting tomorrow, we're going to talk about one strategy we have, which is a PEG ratio strategy. We invested $1 and that's now up $8,300. So it was a pretty decent return. And in 4 weeks, we made 700 something thousand, 756,000% return. That was using the PEG ratio. Sometime thinking about doing the PEG ratio approach. I'm thinking about adding a new investment society meeting next semester, which will be, I'm thinking about doing a strategy incubation meeting where we come in and we throw out our hypothesis and we test strategies. We build incubators, which is what we're doing with this PEG ratio, build an incubator, and we just test it and see how it works. We read articles, you go out there and see what is Cliff Haston saying, what is Arnott saying, what is whoever, and you go test them. That would be pretty cool. That's what we did. In this one, we had a PEG ratio. What we did is the motor in said something in the book that I thought was interesting. The PEG ratios are a good way to screen for stocks as long as you adjust for quality. And so that's what we did. We bought low PEG ratio stocks with high quality factors. And we shorted high PEG ratios with low quality ratings. And that's up, tremendously in 4 weeks. Does that mean it works? No, 4 weeks is not enough. Most hedge funds incubate a strategy for like 3 years. We've gone 4 weeks, so we're not there yet. It could be pure luck. And plus the election, whatever our strategy did, it loved the election. So, all right, the second one is a formula, and it's called sustainable growth. What sustainable growth means is how fast can a company grow without having to issue stock, borrow money? How much can they grow just based on who they are without having to go outside to get more money? And you've probably seen this formula before, sustainable growth. It's the return on equity times how much money they retain. The argument is if they pay all their earnings out as dividends, they can't grow because they don't have anything to invest in the firm. But if they retain, they can grow with the return on equity because essentially they're retaining and making that return on equity, so they'll grow with return on equity.
So that's just one minus dividends.
It's 1 minus the payout ratio. Yeah. Now, how do you get that? So what I recommend is get a Capital IQ account and bring in your company. And when you do that, I'll show you how I would do it. Don't y'all love, once you want to get into the news and it's not talking about the election anymore, give it another 3 weeks. So if you go into my UTSA and go into the library, click on databases, click on C for Capital IQ and give yourself an account. If I can remember my password, that's always questionable. Begin an account. As long as you're using your UTSA.edu account, you're good. I'm going to do Walmart. So you type in their company and just click on any of these financials. Doesn't matter which one. I'm going to click on income statement. Take the date bar and send it all the way back. And right here, it says download financials. If you click on that, this is what you get. I've already loaded one. It's pretty amazing. Capital IQ is pretty amazing. It brings in all of this stuff. Pretty remarkable. Ratios, I mean, one click, you've got all of this stuff. So it's pretty powerful. So on one of these pages, you'll have a return on equity. Not on that page. Let's look at ratios. So here it is on ratios, return on equity. So there's a return on equity the last few years. We'll talk about normalizing a little bit. Let's see if the payout ratio is in here. I'm never sure what they're going to have on each of these pages. Doesn't exist. Okay, so how do you get the retention? So retention, what you need is dividends per share and earnings per share. So dividends per share is probably on the income statement. So you got to do some hunting around to find it. If y'all see it, let me know. Here's the dividends per share right here. I forget what year I'm using. There's 2017 is an AN. That's one of the downsides with this. One thing you might want to do is lock in your orders before you do all this. Where did it go? 77. All right, and AN is 17. It's 2017. There's 2017. We'll go all the way out. And then earnings per share on the same page. Earnings per share, let's do diluted. Go over to AN, $1.46. And so your payout ratio is just your dividends per share divided by your earnings per share. And then your retention ratio is just 1 minus your payout ratio. And our ROE is line 17. Here's your ROE. And so your sustainable growth, it's just ROE times your retention ratio. Now, why did I do multiple years? Well, the reason I did multiple years, I didn't do the last 12 months. I don't like to do the last 12 months. The reason I did multiple years is this idea of normalizing. So if you use just the last year, that looks like an unusually high year. Do you really think they're going to grow 11.2% going forward? Pretty unlikely. You look at the average of the last 4 years, it's 8.7%. So the average looks a little skewed, but maybe not too much. The median, 8.7. So 8.7. Walmart has done extremely well the last few years. COVID has certainly helped, no question. You saw a big impact from COVID. Look at pre-COVID, though. Pre-COVID, the average was only 5%. So COVID certainly had an impact. They're actually doing quite well. They're competing head on with Amazon, which no one really gave them credit for doing that. You know, Walmart put Sears and Montgomery Ward's out of business. They probably put Albertsons out of business, at least in Texas, along with HEB. And people are like, Walmart's going to be taken out by Amazon, but I think Walmart has actually done a pretty good job. So the huge advantage Walmart has is all their stores. So you order online and you can go pick it up from the store, or they'll deliver it to your home. They're not too good at the delivery yet, at least with me. They really messed up with the one delivery I did with them. But pick it up at the store. It's pretty close by. You can get it much faster that way. Curbside, I don't know how good their curbside is. I've never done that with HEB or with Walmart, but there are some things Walmart is doing that's pretty impressive. They're starting to make some headway in India. It's pretty amazing what Flipkart is doing for them. So that's pretty impressive. I can tell every time I visit Latin America that they're taking over Latin America. PriceSmart's kind of their only big competitor there. They're buying out these small retail outlets. Just you can walk in and the name doesn't say Walmart, but you look on the wall and it's owned by Walmart. And they're starting to get into advertising. Well, that could be a big deal. So there's a lot of things. So while 8% sounds like an awfully high growth rate for Walmart, for the next few years, that's possible as they keep implementing these exciting things they're doing. That's what you have to do in your papers. You have to come up with some rationale. So, that's 8.7%. I did NVIDIA last week. I'm doing Walmart now. I should have done NVIDIA. We can try NVIDIA since we're here. So just some practice. So you search for the company, NVDA. I don't know what happened here. Go back as far as you can. I click on the income statement and then download the financials. It does take it a while to download the financials because it is a pretty massive file. But you can see the power of CapIQ. Now, I like CapIQ when you use the add-in for Excel. That's really, really powerful. But even just this, you get your hands on financials much faster, I think, any other source you can go to. You can just dump everything, and they have it very well formatted for you. So if we do the same thing we did before, so the ratios. Now, what is their retention? So their dividends, let's see, it's the same place. It won't be AN. Line 77, slightly different. So their dividends are ridiculous. Their earnings per share, well, don't look too ridiculous if you go back that far. So their payout is very, very small. So the retention, these don't look like NVIDIA numbers to me, but maybe they are. Their ROE is ridiculous, right? So you take their retention times their ROE, you're going to get some crazy, crazy, crazy number. But again, if you take the average, we know this last year is unrepeatable. So the average is 42.7%. Not that radically off the peg ratio approach. So it is an approach. You do need to normalize it. So but do look at it. That's the advantage of Cap IQ. You can just look at it and see, is this last year really unusual or is it pretty normal? Maybe they've been averaging 6, 7% and suddenly it's 32% for 1 year. Or maybe it's like with NVIDIA, the last year, 123%. Well, obviously, if your revenue grows that fast all in 1 year, you're going to have a massive, massive ROE. Can you really, really extrapolate that for the next few years? Probably not, unless there's some pretty good competitors coming in. But that's the sustainable growth formula. And I recommend using Capital IQ just because you need to get Capital IQ on your resume. There are some really, really good online tutorials on Capital IQ. If you just type Capital IQ tutorial in in YouTube and look for the Corporate Finance Institute. They have some really, really great videos. So there's the second approach. We look at the third approach, which is just look at history. And so what does history say? So we go back to Walmart. We're going to go back to their income statement. I want to look at a couple of things here. I am going to put a frame in here. So I'm going to look at some CAGRs. I'm going to look at a 3-year, 5-year, and 10-year. So if you're looking at CAGRs, y'all remember the formula for CAGRs? You use them all the time in finance. So the CAGR is just going to be ending value over the beginning value raised to the 1 over the number of periods minus 1, right? We use that formula a lot in finance. So I'm going to look at the revenue CAGRs. So that's going to be the ending value. I'm not going to use the last 12 months. I'm going to go there, the last year, divided by, I want to do 3 years. So to do 3 years, you have to go back 4 years. 1, 2, 3, 4. You need a beginning year. Raise up to 1 divided by 3 minus 1. So their revenues have grown 5%. Their net income has grown 4.7%. And their earnings per share have grown 6.53%. Why so much higher? That might be because they're buying some of their stock back. You could also do EBITDA. They have EBITDA, they have EBIT. I don't see EBITDA, so there's the 3-year, the 5-year, same thing. You do the last year and divide back. How many years I go back? How many? I'm doing 5 years, you go back 6 years, right? If you're doing 3 years, you go back 4. So 1, 2, 3, 4, 5, 6. Raise to the 1 over 5 minus 1. There's a growth rate over the last 5 years. Their earnings have grown much faster than that, EPS much faster. So the last 5 years is great. Why? Because 5 years ago was 2019, pre-COVID. If you do 5 years versus 3, you get a much, much more substantial earnings growth. Their revenues didn't grow that much, but their earnings grow dramatically. And then for the 10 years, I'll do this year, divide how many years ago back? 11, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Raise it to 1 over 10 minus 1. Much slower growth, right? You go back that far, that's when they were still struggling with Amazon. Actually, their earnings actually fell. The EPS is barely up. So I like to look at revenue just out of curiosity, but it's earnings per share is really what we're looking at. So there you got 3 pretty radical numbers. Longer term, they haven't done well, but this is a firm that's definitely reinvented themselves, benefited greatly from COVID, but also benefited greatly from just what they're doing as strategy-wise. They've grown overseas, all these kind of things. So I might somewhat discount the 10 years, but the 5 is probably exaggerated, but history might suggest if you use the shorter term, maybe you're talking 6.5% growth. You just have to discuss these, and you got 3 radically different numbers. Well, I didn't do them on the first one, but 8.7 versus 6.5. And then the last one's just your opinion. And this is where your creative writing comes in. So you want to pick a firm you know something about, that you can talk about their strategy, what they're doing, anything you're excited about they're doing. Some firms, much more exciting. You look at a SpaceX, that's pretty exciting. Starlink, my word, how many orbits he's going to put up there, satellites he's going to put in orbit. That's radically changing the world. It's obviously very, very beneficial. But who knows if you can value that firm, because we don't know if they have positive free cash flow. You're going to have that for it to work. So you have to start with that. Spotify stock is up a bunch today. What's Spotify doing that anybody cares about? So we started using Spotify for our podcasts. That's the only time I've ever used Spotify. I can never find it on my phone. I know it's on there somewhere. I have to search for it. But they're doing well. Did they release earnings? Anybody know why Spotify's up a bunch today? Did Trump say something about Spotify? That seems to be the most important. Forecast profits above estimates on cost cuts. Spotify releases financial results. So yeah, they released earnings. When did they release the earnings, do you think? Was it before open today or after close today? What does the stock market tell you? Probably after. And how can you check? You look at historical data and you look at the volumes, and we'll probably see much higher volumes tomorrow. That'll probably be the date that'll be important. Their volumes are pretty radical, pretty consistent for a while, and then suddenly they jump. So could you do Spotify? I don't know enough about Spotify. I know where the growth is, what they're doing to actually generate more revenue. I don't even know how Spotify makes revenue. Is it all advertising? Do they have subscription accounts? Do they have subscribers? So I don't know. I don't use Spotify um, other than our podcast. We're doing that for free. So you have to understand the business. You can't just say you're excited about their product. You really love their product, like Facebook, but you never pay Facebook any money. You're like, okay, well, wait, I'm not the customer. I got to figure out who the customer is. Why do they pay Facebook money? And what are they looking at? So you got to be real careful on that. If Netflix starts doing football and sports and soccer, that sounds great, but those are really expensive productions to acquire. You don't do an NFL game for free. What's the revenue pickup? What's the cost? You got to understand those pieces. So, got to understand the business. It's not just like, wow, they're doing NFL sports games now. Everybody's going to be watching. Well, yeah, they're going to spend several $1 million to get the rights to that. So you got to really understand the business. That's why I love business breakdowns so much. They do such a great job. He almost always asks the question on how much is the cost for you to acquire a new customer? And once you get the new customer, what's the dynamics? What's the revenue? What's the cost of goods sold? What's the other expenses? The upfront cost to get the customer versus the ongoing revenue. How long does it take before you pay off those upfront costs? That's how you have to understand a business. So you want to pick a company for paper 3 and 4 that you have some knowledge about, some excitement about that you're going to really write about. That's why I picked Walmart, because that's a pretty boring company. So probably none of y'all want to do that particular company. But it finally comes down to your opinion and your story. One video you really got to watch is the Motorin and storytelling. It's one of his best videos. The value of stories in business. I highly recommend this video. He says far too many people in finance are all quant and no storytelling. And if you can't do the storytelling, you will not succeed in an investment job, because you don't get paid for good ideas. You get paid for good ideas that the portfolio manager executes. And you get the portfolio manager to execute by putting a spin on the story. And that means you got to understand the business. So he talks in this one, he talks about Uber. He talks about Ferrari. He asks, is Uber a mobility firm or is it a transportation firm? Is Uber a delivery service? Is it a taxi service? One of the businesses we support in Costa Rica, when I first heard it, I thought, man, that doesn't sound good. It's a taxi service. Who's going to pay for it? And then they got a bus that charges $1 to get anywhere. Why would a taxi service? But he's not a taxi service, is he? He's a delivery service. He's delivering refrigerators. He just happens to take people with him when he goes to get someone's refrigerator. That's where his real business is. When I heard, I don't know if you heard that story, but he and his wife, man, they got that thing down. They know it. She knew the business as well as he did. She was like correcting him constantly. It was really an incredible partnership. Once I heard that, I say, okay, I can see how this is work. You're up in the jungles. People need stuff. You've got a truck. You'll get it for them. You'll charge them. That makes a lot of sense. Yeah, that's a good business. So that's what he's talking about, the storytelling, understanding the business in a way that you can get excited, and that really gets you to the growth rate. What is here? Remember, for Demodoran, he talks about, we said this before, possible, plausible, Improbable. It's a good way to think about it. Possible. Wow, this firm would be worth $6 trillion if they can do that, but no one's doing it yet. It may not work. Plausible. I can see them doing that. Some people have done it. Might be possible. I mean, could happen. More likely than possible. They've tested it. It's not quite taken off, but maybe it could work. And improbable, they're doing it. It's working. They just got to scale it. That's the kind of thing you're thinking about in your analysis. You might even run scenarios where you value the company in those three scenarios and just see what is that upside, what's the downside. That's the last question they ask on business breakdown. What's the worst case scenario for this company? So you buy the stock today, and 5 years from now, you're really disappointed. What happened? Get you thinking about the downside. So this possible can be both positive and negative. So you're thinking about Blockbuster several years ago. Hey, Blockbuster, what if people stop renting CDs from a store and they do everything online streaming? Is that possible? Oh man, the bandwidth isn't there. It takes far too long. There's not enough server capacity. Yeah, but what if that were to happen? What would you do? Oh, we'll just get into that business. Yeah, but Netflix is already doing it. That's the kind of question. You can ask it on the negative side as well as on the positive side. So, but that's the story side of it. Really, really important. Getting excited about a company in a way that you can get someone to buy the stock. All right. So those are your growth rates. This is a huge part of paper 4 is getting these growth rates and writing through that. All right. So you got 4 approaches. Those are all in the notes as well. So approach 1, the PEG ratio approach. Approach 2, or the approach 1 is historical growth. I've got a different order here. The PEG ratio approach, and then sustainable growth. So then the only other question you have to ask is how long is it going to take for you to get from the short-term growth until you get to that ultimate terminal growth? With a firm like Campbell Soup, you might already be there. Your short-term growth and terminal growth might be the same number because you just don't have any exciting story to say. Maybe the only thing you have for Campbell Soup is population growth and inflation, maybe some productivity. It's just not getting maybe a 4% growth company. A firm like NVIDIA, AI is just taking off. It really hasn't taken over our world yet. There's a lot of fear of how it's going to take over our world. That could work. The one thing to be really conscious of is high growth rates rarely last more than 5 or so years. 10 years is a very long time. And while you're thinking about Microsoft and NVIDIA and Apple, yeah, you're talking about 5 or 6 companies out of 80,000 companies. It's very rare for companies to grow. I mean, Intel would be in that category. Intel was one of those rapid growing companies. How are they doing today? Have y'all looked at Intel this year? How's Intel doing? How many of y'all wish you had Intel in your portfolio at the beginning of this year? Anybody? One of the worst performing stocks in the S&P 500. I think they're in the Dow, aren't they? And they might get replaced from the Dow because they've done so horribly. So a stock that was trading at $50 and now it's at $24. This is Intel. This was the darling of Wall Street. Before your time, we had this thing called Intel Inside. Did y'all ever see those commercials? Is that before your time? Intel Inside. So every desktop computer, Intel Inside. Don't buy it unless it's an Intel chip. And now it's completely just disintegrated. They may even spin off their fab business. Who knows what they're going to do? Who knows what happens to Intel if China attacks Taiwan? That could be either devastating for them or it could actually in some ways help them. Who knows? But how do you get a story? Now, this is a stock people would say, oh, this company's going to grow really rapidly for 10, 15, 20 years. Look at desktop computers. And then they missed the whole iPhone and now it's, AI putting chips in the cars. They've missed a lot of that because they're so focused on the desktop. And that's really, really causing them to suffer. It's now only a $100 billion stock. This used to be one of the largest stocks in the market. And now it's, Apple could buy them with just cash and still have half their cash left over afterwards. So you got to decide that length of time is probably the most difficult thing our paper for. but try to figure out some rationale for what you're going to do. I'd recommend picking a company where you're not already at your terminal growth, a firm that's mature, even declining. That's kind of boring. So find a firm that does have an exciting short-term growth to do, gives you something more interesting to write about, and then you have to think about how long will it take. The motoring gives some good examples, and my approach is very similar to his, is try to figure out the ultimate market. So if you're talking about electronic vehicles, what's that ultimate market? And then think about their ultimate market share of that market. What will that actually be? How long will it take to get there? And some things like electronic vehicles, you can go out to Google and search that, and there are people out there forecasting that already. Same thing with AI. How long will it take for AI to really take over our world? There are people out there, people called futurists. They're interesting people. USAE hired a futurist to come talk to us. Very interesting people. I wish I had recorded it because my guess is everything he said was probably very wrong. He was looking out over the next 50 years. I'm sure he missed a lot of stuff, but they're interesting people. They're talking about what's the big thing going on. Or you can go to a firm like ARC. Y'all watch Kathy Wood. Go to ARC and see what she's buying. And she just bought Crisp, right? So a firm that's down a bunch, and she's thinking maybe to come back. So there are some interesting plays that give you really, really good discussion. I think microbes are a really big part of healthcare that hasn't taken off yet, but could be a game changer. The firms doing that are not making any money, so they don't work well for papers 3 and 4 because you really want a firm that has positive earnings. But that's really interesting. I could make a really long-term story there because they could cure a lot of diseases. Eli Lilly, what's their big growth story? Why are they up so much? So they've got these GP whatever things. Is that already in the price, or is there more growth to go? That looks like a good stock. Which stock do you wish you had December 31st, Intel or Lilly? Pretty obvious, right? Now they come out here recently because there's competitors coming in, but they've got this pill that works for diabetes. It also causes people to lose weight. It also helps people with addictions. It also helps people with Alzheimer's. It also cures the common cold. Who knows? It's gonna everything there is that's ever existed. This drug is going to cure. But they've got competitors coming in. You know, they're trying to do it so you don't have to do a shot. You can do it as a pill. What's the one thing we don't know are the long-term side effects of these drugs, what's going to happen there and what it's going to do to us. You know, there's a lot of things we've been excited about that now are major lawsuits. So these are more exciting firms to talk about because you have something really meaty to sink into in your paper 4. And it's all about these growth rates. Ultimately, it comes down to your opinion. So you can talk about these other things, but ultimately, it's your opinion, what you think. You could read some analyst report. You can get those off of Bloomberg. You can get those off of Merchant Online from the UTSA library and just see what are the analysts saying about your firm. You can listen to their earnings call. No, you're trying to find those stories. I was listening to Zuckerberg the other day. He's up with something now he thinks can be some game changer, but you could tell the person interviewing him wasn't all that convinced. Musk is talking about robotic taxis. Google was talking about creating their own autonomous vehicles. Apple was going to have their own autonomous vehicle. Apple has Apple TV. There's a lot of things pressuring these firms from Europe because of antitrust. You know, there's all these things going on. That's your job as an analyst, is to synthesize this in a way that you either get people excited to buy the stock or you get people excited to short the stock. Either way, you're looking at it. So it doesn't have to be positive. It can be very negative. You think a stock is overvalued, you can certainly make that argument. All right, so let's value a stock. I'm building a video. I'm gonna walk you through the video that I've already done. I'm completing it. So I've finished paper 3 part of the video, and this is my file from that. And so I'm going to walk through this today and on Thursday, and then you can watch the video once I get it completed.
You explain your ranges for the data center.
The ranges for what?
The ranges like split out.
On which,
On that, not an Excel file.
well, y'all haven't seen this before. This one here.
Yeah.
Y'all haven't seen it yet, but oh, this is one. Yeah, this is one I did for the video, so I haven't shown y'all this yet.
Did you make ranges like you go from like 0.3 to 0.5 and you make ranges to estimate like a beta?
Yeah, when we talk about beta, I do have ranges. I'm not asking y'all to do scenarios, but I do recommend it. We'll talk some about. I might do one for y'all to show how you can do a kind of a data table. I mean, ultimately, in my security analysis class, they're required to do a football chart. So this is the approach you see all the time today. Is the football approach. So if you want to try it, I'd recommend getting in the, try to get in this paper 4 because it really looks good on LinkedIn. This is the approach. I like this approach. It's not bad, but essentially what it says is we value this stock using 5 different approaches, and we did scenarios, low end and high end, and we graph those. Here's the current stock price. And what you do with the football chart is you're comparing the downside risk to the upside potential and make a decision whether you're going to buy this stock or not. Every stock, you're not going to find a stock where the current price is below all of your valuations unless you made some error somewhere or the stock market's really wrong. So most of them, the current stock price is going to be somewhere in that range, but you're looking at the upside versus the downside. So yeah, you'll see it, all different versions. They're fairly easy to create charts. You got to do a little bit of manipulation on the bar chart to get it to work, but it's pretty common approach. So sometimes you stick something in your paper because it's the going thing and you just want to show off for your next employer. So this is one of those going things. So my security analysis class has to do this. I'm not asking y'all on paper 3 and 4 to do scenarios. I'm only asking to give me one valuation, but if you want to, you can certainly add this into the paper, and I'd certainly give you extra brownie points for doing that. Would certainly be valuable to your interviewing. But what you're going to see in my video is walking through paper 3, which is the discount rate. So here's paper 3, the discount rate. Now in paper 3, I don't need a big dissertation on the capital asset pricing model. Your boss doesn't want that, all right? They'd find that insulting that you're teaching them undergraduate finance. You can say, in this section of the paper, I'm going to be coming up with a discount rate for my firm using capital asset pricing model. That's probably enough. If you want to give the formula, that's fine. Just a reminder, but be careful with your boss that you're not. We had an intern once. He came in the first meeting and he's explaining this basic undergraduate stuff to us like we never heard it before. And we were all very polite and listening, but it's like very insulting to the rest of us for his explaining to us basic. He was like, yeah, I was working this morning. I discovered 2 + 2 = 4. I just want to let y'all know that. That's that kind of level of insulting our intelligence. So we just all go, yeah, that's interesting. So you don't want to do that. Your boss knows all of this. So, you talk to your boss as if they know it. If they don't know it, then you jump in and explain it. But yeah, so write your paper like you're writing to a portfolio manager, not to someone who knows nothing about finance. So the risk-free rate, I've kept this fairly pretty simple. The 10-year treasury yield is your risk-free rate. For most stock investors, use the 10-year treasury yield. I would probably mention that just a few years ago, that number was unusually low, 0.5%. And then what I do, and I'll show you in the video, I would probably bring in the history of the 10-year treasury. You can just get this from the Federal Reserve and just show that we're back up to more normal levels. So we got the unusual levels. So if you're writing back in 2020, you would probably have to adjust your risk-free rate to reflect the fact that we're in just an unusually low period of time. But so the first part, the risk-free rate's much simpler now. You can get the 10-year treasury yield from Yahoo Finance. Today it was at 442, so it will change every single day. So you just have to pick a day and use it. I think the day I did this, it was at 431. So I just rounded it to a round number. I like to have round numbers so I can remember them. So I just use 430. So risk-free rate's fairly straightforward. Why the 10-year? There are people who use the 5 years. Some people use the T-bill. Some use the 20, some use the 30. The 10-year is just like the most stable. It's the most reflective of what's going on with interest rates. The 5-year is pretty volatile. It moves up and down a lot more. Short term is way too volatile. So the 10-year is more stable. The 20 and 30-year are not really risk-free rates. They have their own markets. They have their own investors. It's a supply and demand thing, so you can get a little out of whack. But there is a debate. Most people use the 10-year is just the most common number to use. USAA, our CEO used the 5-year. I was going to debate him on that, but he never gave us a chance. He just said use the 5-year. But 10-year is the more common approach, right? So you don't need to explain that why you're using the 10-year. You can get away in evaluation just using the 10-year. Now, in my security analysis class, we use a capital IQ model. They actually have a drop down that you can pick which treasury you want to use as your risk free. I wouldn't do that. I would just use the 10-year, but so there are some people that is something they do as a selection. All right, so that's the easy one. That's maybe 2 or 3 paragraphs at most. Then the market risk premium. Remember the market risk premium. For the risk-free rate, market risk premium, you say absolutely nothing about your company. The market risk premium has nothing to do with your company whatsoever, right? The market risk premium is the extra return you need over the risk-free rate for you to buy stocks, not your company stock, but to buy stock. It's the risk premium to be in the US stock market, essentially the S&P 500. So how much more do you need in return from the S&P 500 over the risk-free rate to induce you to invest in the S&P 500? That's what the market risk premium is. You'll often hear it referred to as the most important number in finance. I've heard Warren Buffett, I think he calls it the most important number in investing. Extremely important number, the market risk premium. It's the additional return you need over the market. Now, some of your classes might have done it like this. Have y'all seen that before? The required return minus the risk-free rate, retired journal stocks. That's how academia does it. You'll never see that again after you graduate. So I would learn it like this. That's the way we do it. We don't talk about the required journal stocks minus the risk-free rate. We just say the market risk premium. We just talk to market risk premium. All right. Which approach are we going to do to get that? So this is a very theoretical discussion. There's no place to look this up. And I think there's a major flaw in academia because we say, what is the market risk premium? As if it's a number for the average investor out there. But the truth is, this is your number. What is your market risk premium? Well, how much do you need to make? But no one ever expresses that in academia. They always talk about what is it for the average investor out there? What do you care about the average investor? You're the one investing. What is your market risk premium? That's the only thing you should care about. But we don't do that. In academia, we're like, what's the average person think? So what does the average person think? Well, the most common approach my entire career was the historical approach, Dr. Ibbotson. I got to meet him, I think twice I got to meet him. Famous guy in finance. He does podcasts. I'd listen to him. Very impressive guy, really big guy. He's like 6'4", kind of intimidating guy, but a really smart guy. University of Chicago. He was the one who came up with the historical approach. And essentially what he said is, hey, you know what? We don't know what investors require going forward, but we know what they got historically. Let's just use that. Stocks made 10%. The risk-free rate was 4%. The market risk premium 6%. So his argument is they got what they were expecting, what they needed. That's what they need going forward. Let's just do that. That's the historical approach. The problem with the historical approach is it assumes stock investors got the risk premium that they require. I don't think that's true. I think they actually were surprised, very pleasantly surprised in the United States, and they actually got much higher return than they required. They ended up with more than they needed to compensate them for risk because the U.S. was such a great place to be an investor. And then several years ago, Barclays came out with their approach. I think I put the Barclays article out there. It's dated, but it's still a really good read. It's called the implied approach. Almost the entire world is now using the implied approach. And the implied approach says we don't know what the required return on stocks is. We don't know what investors require, but we can certainly come up with what we expect stocks to make. And we can calculate that number. And let's just assume those numbers are the same. All right. We might have gone through this in a previous class. I can't remember what class. I got 3 classes all hitting on this at the same time. So redundancy is okay because you really need to learn this. We're talking about the most important number in finance. So let's learn it. So why would this be true? Because markets are efficient. Stocks should have a required return that equals the expected return, because if not, it should get back into compliance with that. We've already talked about the expected return on stocks. You did that on exam 1. It's your current yield plus expected earnings growth. That we've already covered. You've got a chart that shows you that. Oh, I didn't put that chart in the paper, but that's the expected return on stocks. I did give you a chart that does that. So current yield is what? I'm going to recommend that you do the current yield as the current dividend yield plus a buyback yield. All right. The video shows you where to get the current dividend yield. It's the current yield on the SPY, which is the exchange traded fund on the S&P 500. At the time I did this, I think it was 1.23%. So I just rounded it to 1.25. And then I'm just going to give you this number. The buyback yield is how much firms are buying their own stock back. There's an article. I think I might have put it on Canvas. I can't remember. There's an article. Ibbotson. I'll just talk about Ibbotson as the historical approach. He wrote an article on the buyback yield. He says it's about 1.5%. He wrote that 7 years ago. I've been testing it since, and all of his numbers are still similar. Nothing radically has changed. So I'm recommending you put that into your numbers, because if you don't, you're going to get a really bizarre valuation in paper 4. So I'm doing you a favor so you don't value NVIDIA at $87,000 a share, because you're going to need that extra because the dividend yield is so low. And firms are, on average, buying back more of their stock than paying dividends. Remember, in this section, you want to lose a ton of points. You talk about your firm. You give your firm's dividend yield. You look at your firm's buyback. This has nothing to do with your firm. This is the average investor for the entire stock market, all right? Don't say anything. You shouldn't mention your firm anywhere in the risk-free rate market risk premium. It should never even come up, okay? This is for every stock. Whatever you come up here, it's going to work for every single stock in the market. Okay, there's my current yield and expected earnings growth. We already talked about that. We're going to tie that to nominal GDP growth, which y'all remember: productivity, labor growth, and inflation. And in the video, I'll talk about that. These 2 charts out there. So we'll come back to this. I will talk in this part. So refresh your memory on this. It's a good refresher from paper 1. So we'll start right here. Okay, I haven't looked at the team questions on bonds yet. We'll do that today. They look pretty good just looking at answers last time, but if there's some problems, we'll do another question. But as far as exam 2 and the teams, we'll have a team question next week. I'm not sure if it'd be Tuesday or Thursday, but on the discount rate for stocks and CAPM. That's going to follow pretty closely what you do on paper 3, and you'll have an exam question on that one. Then we got to do stock valuation, which usually is the highest scoring question on the exam, because it's just plugging numbers into really simple formulas. We have relative value, which we'll talk about today. And then we have options. Options in the past has been pretty weak, but over time, students have gotten better at it. So we'll do some options. I don't understand my video on options. I did a real quick video for an exam review, like, I don't know, 7 or 8 years ago, thinking I have like 50 students in a class would look at it. That video now has 131,000 views for some reason. I don't know why. That video is, people are writing comments like, "This saved my life," which I think that's a little bit of exaggeration. It's a really simple video. So we're not getting into the options. Some people think that video, if they understand that video, understand options, it's incredibly basic. So I don't know why that video is so popular. I'm thinking about I might be able to actually make money off of YouTube now just off of that one video. I don't know why it's so popular. But we'll do options fairly straightforward. We're only going to do intrinsic value on options. If you want to get more into it, UTSA does have the speculative markets class that you could take. I think Brian is teaching that. Get into the different option pricing models. And he does more than just options, uses futures and other things, but gives you some exposure to that. But that's it. The things that we've done so far is we calculated returns, a bond, and essentially that is exam two right there. So we're walking through them. You did really well on calculating returns. For the team question, it looks like valuing bonds. At least some of the teams did well on that. So we'll do KE for stocks probably next week, and then the week of Thanksgiving, we'll do stock valuation, and then we'll do the option question on the very last day. We'll see how close the teams are. I've had some classes where the entire team competition was decided on the very last class. So we'll see. One team this semester is getting a little bit ahead. That might have some safety net there, safety margin. All right, so that's where we're going. So we've gotten two of these done on the teams, and then just four more to go, and we'll knock these two out pretty quickly. This is the most involved question on the exam. It's not necessarily an essay question, but it does require some writing. And this one requires a little bit of writing. We'll do that today. As far as the KE for stocks, so your papers 3 and 4 are due, I think, December 7th, which is after the last class. So I'm going to have a video hopefully this weekend. I'm over halfway through it. The challenge I'm having is while I'm doing the video, I have to go get stuff and bring it together. And so I'm having to go through the video and edit out me going out and looking for stuff because I'll click on the internet and it's hourglassing and I don't want all that. So it takes me a long time to edit. You know, if it's a 50-minute video, it's going to take me 3 times out to edit it because I have to go through the whole thing and listen to it. So, but hopefully this week I'll have it so that you have a video that you can just watch the video and write the paper as you're watching it for your company. Pick a company, any company besides Walmart, because I do Walmart in the video. This is the file for the video. I won't give you this file, but you can create your own. So we talked about this. For paper 3, you got to come up with a risk-free rate. Going to be pretty straightforward, other than you might put a chart in that shows the history of the 10-year treasury yield to somewhat justify why you're using the current 10-year treasury yield. The market risk premium, that one you'll see when we practice through the team question. So we're using the implied approach. So what do you think stocks are expected to return? We're going to use that. Ours are required return. And that's going to give us a market risk premium or equity risk premium. So there's a few charts on paper 3 that you would bring into that. Here's a few that I show on the video. I put 4 in there. You could do a couple more of 4 charts that could make sense for that paper. So you come up with your market risk premium. And then beta. Beta is a 4-step process. So we'll get into that a little bit today. We'll do it again, just a review, but you got to define what kind of company it is. Is it defensive or cyclical? Look at operating leverage and financial leverage, and then look at the history. I'm not sure how many times we've done this in this class because I've got 3 classes all doing this at the same time. Does this look familiar? Revenue sensitivity, op leverage, financial leverage? No, well, we'll cover it today, but it might be a little repetitive. So that's coming up with the beta. But for CAPM, you got a risk-free rate plus the market risk premium times beta. You should have had that in 3013. Risk-free rate is the 10-year treasury yield today. In some years, you have to adjust it a little bit, but this year not. Market risk premium is your expected return on stocks minus your risk-free rate. And then beta is company specific. So when you write paper 3, I count off a huge amount if you talk about your stock when you're doing risk-free rate and market risk premium. So your company has nothing to do with the market risk premium. Then I'll get the rest of it built here pretty soon. So stock valuation. So the risk-free rate, we generally use the 10-year treasury. You'll see some discussion in my paper about adjusting it. That's no longer in my notes. You no longer need to adjust it. So I wrote these notes when the 10-year treasury was unusually low. You think about in 2020 when it hit 0.5. What are you going to do with that? The motor end says just use a 10-year treasury no matter what it is. When it got down to 0.5, I said you got to normalize it. You just can't use that low of a number. But I don't believe that anymore. So you have to somewhat ignore that in the file and the notes. So you've got it easy now because you can just use the 10-year treasury, what it is. Today, I think it dropped down to 4.35 or something. But you can just go on the Yahoo Finance. Just click on rates, depending on which version of this you get. So the 10 years at 4.42. Bonds rallied a little bit today, but 4.42. Remember, it was at like 3.7 not too long ago, so it's really sold off quite a bit. But 10-year, why the 10-year and not the 5-year or the 1-year or the 30-year? If you pick the 10-year, you don't have to worry about that. If you pick another one, you'll have to write another 16 pages explaining why you're using that rate, not the 10-year. So if you pick the 10-year, you're good, because that's what most people do. It's when you pick something besides the 10-year, you have to justify why you're picking something else. So my guess is most of y'all are going to use the 10-year. That's pretty common. So 4.42 right now, you can round it. You could even round it to 4.4 if you want a really round number. When I did the video, it was 4.31, so I used 4.3. So you can get the yield there. So the market risk premium, market risk premium, also known as the equity risk premium, often referred to as the most important number in finance. That's the required return on stocks in general. It has nothing to do with your company. So remember, if you talk about your company under the market risk premium, you're making a big mistake. It has nothing to do with your company. You're talking about all stocks, usually the Standard & Poor's S&P 500 stock index. So how much do people buying the S&P 500 stock index, how much extra return do they need over the 10-year treasury to compensate them for the risk? That's what we're looking for there. There's no place to look up that number. So when I started my career, it was the historical approach where we just looked at what stocks earned historically versus the risk-free rate. And that difference, we just assumed that's what stockholders needed. Going forward, people are using the implied approach. The implied approach hit about 10 years into my career, and everybody just switched to the implied approach. What the implied approach says is we can't calculate the required return on stocks because we don't know that. That's some theoretical fictitious number. But we can figure out what stocks are expected return. So let's just assume the expected return and the required return are the same number. Markets are efficient. That makes a lot of sense. So let's go figure out what we think stocks are expected to return. And you've already seen that from exam 1. Stocks give you a dividend yield plus the expected earnings growth. So the expected return on stocks is the current yield on stocks. I don't have it in the notes there. Expected return on stocks plus the current yield on stocks plus expected growth in stocks. Expected return on stocks is current yield plus expected earnings growth. Remember that from exam 1. What's the current yield on stocks? Well, here I'm going to recommend that you add in a little extra factor here. The current yield on the U.S. stock market, the last time I checked was 125. It might be a little bit higher today. But if you just find the SPY in Yahoo Finance and get its current yield, yeah, still 1.23. 1.23, I rounded it up to 1.25. That's the yield. That's the dividend yield on stocks. That used to be all we used, and that number used to be 4%. It's now 1.23%. But in the last 10 years, companies have been buying more of their stock back than they've been paying dividends. It used to be a negative number. It used to be firms issued more stock than they purchased. today they're purchasing a lot more of their stock back than they're issuing, and that's actually a higher yield than their dividend yield. So I'm recommending you use this on your paper and just use this number. You don't need to write much about this. You can just say you're using that. You can say, according to my finance class, the current buyback yield is about 1.5%. So I'm going to use that. The reason I'm recommending you do that is when you get the paper for the value of your firm, if you don't use that, you're going to get some really weird valuations. You really need that number to have a decent discount rate for stocks. So those two are pretty easy. Then all we need to know is expected growth and earnings. We talked about that for exam one. Corporate earnings growth grow about the same speed as U.S. economy. I gave you this graph here that shows you that. I don't know if y'all remember this graph here, but it shows you in the green, the growth in our economy, and the red is growth in corporate earnings. You can see over time, our economy's grown 6.4%, and corporate earnings are grown 6.1%. Those two should be, you can see that corporate earnings have never grown faster than our economy. So the growth in our economy is somewhat of the top. But corporate earnings have come close. In fact, a few years ago, corporate earnings had almost the exact same growth rate as our economy. This is over the very, very long time. These are all linked together. So corporate earnings have grown 6.1%. Our economy's grown 6.4%. So if we figure out how fast the economy is going to grow, we'll have a pretty good ballpark for how fast earnings are going to grow. And how do earnings grow? Y'all remember this from exam one? I mean, how does the economy grow? Excuse me. How does the economy grow? I gave y'all this chart over here. Y'all remember this chart from exam one? Productivity growth, labor growth, and inflation. So you'll talk about each one of these in paper three. What do you think our economy is going to grow? I gave you the medians here, and that comes out to 6%. I don't believe the medians is the right number because inflation's too high, and I think labor growth is too high. But as I said, for economic growth, for most people right now, they're going to expect our economy to grow somewhere in the 4 to 6% range. And again, that's on a nominal level, not on a real level. If you want to do this as a chart, you can just type nominal GDP and Fred. I don't know if I've shown y'all Fred before, but you can do all kinds of things with Fred. You just type Fred, gives you Federal Reserve. You can just click on it. I like to do percentage change from a year ago. That shows you the number. If you do the average, it's 6.4, what I just showed you, right? 6.4%. The median is 6.1. Why is the median lower? Because of that high inflation in the 70s. This is nominal GDP, includes inflation. And so when you look at the chart, in the 70s, inflation was so high, it artificially changed that number. Real GDP was 4%, still pretty strong, but overall GDP was 11% because of the high inflation. So the median is going to be lower. One thing I also like to do, these are quarterly numbers. I like to do rolling 10 years because it just gives you a good sense of the kind of the trend. I don't do this on the video, but it is a powerful thing to do. And you really see our economy has slowed here. And it's come back here recently because we come out of COVID. So COVID brought that number down definitely, and you see a little bit of bounce with COVID and over COVID, and then the slowdown. Now, some of this is high because inflation's high again, right? Because we had high inflation in 2022, that artificially raises that number. But you can see why I'm saying 4 to 6%. Does that make sense? Look at the last, these are rolling 10 years. So look at the last several decades. between 4 and 6%. If you're going to argue our economy is going to grow 7, 8%, it's just very, very unlikely, especially for a country with 30-something trillion dollars in debt and huge deficits. The government has essentially borrowed growth in the future. It's going to be tough. If you're reading Lacey Hunt's articles, you're going to be even more pessimistic. But you can do something like that if you like to give some sense of how fast our economy has been growing. But this shows you the same information, but it breaks it up into components. So you can see productivity is generally raised between 2 and 3%. It was only 1% this last decade. Labor growth has been about 1% or so with a really bad decade. And then inflation is just all over the place. So when you're looking at expected growth in our economy, these are my numbers. You can use your own numbers, but again, your final numbers should probably be between 4 and 6%. If you go below 4%, you're really pessimistic. You can get a really, really, really weird valuation. If you go above 6%, you're somewhat out of normality. You're really optimistic about the next several years, and I guess that's good to be optimistic, but you're gonna have a tough time justifying it. Productivity growth, 2%, labor growth, maybe 1%, or maybe it's 2.5% productivity, 0.5% labor. People are talking about AI and robotics. Who knows what's going to happen with those? I was listening to a video the other day that AI is like a human with a 120 IQ, but 120 IQ on every single topic all at once. So I've got probably a higher than 100 IQ on finance and somewhere in the 40s on engineering and doing anything mechanical. But AI is 120 on everything. It's probably going to be at 200 here not too long from now. Who knows what AI is going to do for us? I don't think we figured that out. But if AI takes off, I think you could argue that labor growth may not be so fast because we won't need all these workers because the robots can do everything. Who knows? And then I'm going to use a 2% for inflation. Guess what's the Fed saying? But you could use a higher number than that. So you could get the 6% by taking productivity grow up to 2.5%, take inflation up to 2.5%. You could get the 6%. I think that's on the high end. If you did productivity at 3%, I think you're going to have to cut labor down and offset it. So I think really about the only way you can get well above 6, if you really think the government's going to monetize the deficit, just have high inflation. But I'm kind of in the 2-1-2 camp myself. The last GDP number was 4.9. We did get 6.5%, but remember that's back. What's driving to 2022? Coming out of COVID and high inflation. Remember, inflation like 6.5%. You add that on top of 4% real GDP, you're talking, 10-something% growth. These numbers are exaggerated because of COVID. So we had some really bad numbers and we had some good numbers coming out of COVID. But if you look at just the last few quarters, we haven't hit 6% in quite a while. Before that, I mean, when's the last time you see a 6%? You seen any 6% in there? You got to go back to your not your high school days, your elementary school days. The last time you saw a 6, is that too far back? There's 18 years. I'm sorry, your preschool days. So some of y'all might not have been born last time we had a 6%. This is nominal GDP. I'm not talking real GDP. These look like real GDP numbers. They're so horrendously horrible. These are nominal. They include inflation. So yeah, it's been pretty pathetic. These are rolling 10 years, and even with the rolling 10 years, you had such a bad period there. And a lot of that is because productivity. I went in the Fed and pulled the Federal Reserve data on productivity just to show the productivity numbers. And again, 1.5 to 2.5% is pretty normal. We did get some high productivity going into the 2008 crisis, and then that dropped off. Productivity has been really, really weak the last few decades, the last couple of decades. It's really low, not just in the U.S., but just practically everywhere. It's still high in China because they're moving people from the countryside into the cities, and that makes people more productive. But just hasn't been great. I did the same thing with job growth. You can see the impact of COVID in those numbers, really, really material. But you can see the 1% somewhat justified in the last few years, but look how low it was for just that one whole decade. Just really, really low job growth, pretty pathetic job growth. So you can do charts like that in your paper and just get some extra bonus points just to justify where you got your numbers. So I'm going to say our economy is going to grow about 5%. 5% plus the yield gives you an expected returns on stocks of 775. You subtract the risk-free rate, you get a market risk premium of 3.45. If you want to really add stuff to your paper, go out and find the Motorin, click on his current data, and he will have the implied equity risk premium. That's by country, I think. Oh, no, this is for the US. There's the implied number. He's using 460 because his expected return on his expected growth is 874. He doesn't use my economic number. He's using analyst forecasts. Want to know about analyst forecasts? They're notoriously horribly wrong. They're horribly optimistic, so they're way too high, and they're horribly wrong. The correlation is terrible. Firms that have grown fast historically, they give them high growth rates. Firms that have grown slowly historically, they give them low growth rate. And the exact opposite happens. Firms with high growth actually slow down. Firms with low growth actually speed up. So analysts are horrible predictors. But you can see historically he's had numbers closer to mine. So his are more volatile, but it's his approach. But you can see his market risk premium is quite a bit higher at 4.6. Mine's 375. But that's because he's expecting stocks to earn a whole lot more. You can look at his columns, very similar. There's his dividends plus buyback. So he's doing the same thing I'm doing. He's adding dividends plus buyback. So he's got a very similar approach, not exactly the same approach. But here's my approach. So my market risk premium is a little bit lower because my expected return on stocks is lower. If he's expecting earnings growth of 8%, he's talking about stocks making 10%, which I think is pretty ridiculous in this environment. But all right, so you'll walk through that on paper 3, and then you got to come up with your beta. So let's refresh on beta here, or maybe this is the first time. I can't remember. Here's the Motorin. His numbers, the latest I saw them. The blue is the risk-free rate, and the light blue is the market risk premium. So you can see his expected return on stocks is, I think it's got to be in the 7 to 9% range. You can see he got down as low even in 5.5% range, and he's gotten up to 10. It looks like here recently he's gotten back up to 10. I'm generally in the 7 to 9% range. He's in the 6 to 10% range, but you can see he's trailed around 8% fairly consistently until interest rates really fall a bunch. This is back in 2020 when interest rates fell so low. And then now he's got higher analyst expectations on growth. But you could certainly put a chart like that in your paper. I even give you the link there. All right, so there's the market risk premium. And then for beta, you're going to do this on the exam, and you're going to do it in paper 3. How do you come up with a beta? I'm amazingly similar to the Motorin. If you watch him, you're going to think I'm copying him. I never saw any of his classes when I built this. I developed this years ago listening to a portfolio manager. So I don't know why my approach is so similar. It's practically identical. I can't think of any reason it's not exactly the same as his. So beta is a forecast. It's the number you're going to forecast. The first thing you can do with beta is decide if your firm is cyclical or defensive, just like we did on exam 1. So when you pick a company to do for paper 3, you could do the same firm you did for paper 2 if you like. So you have a little more history there, have something you can talk about. Is your firm cyclical or defensive? So on paper 2, some of y'all did Tesla. What is Tesla, cyclical or defensive? cyclical, high beta, right? I can't remember the other companies we did. Meta, what is Meta? Probably cyclical. It's an advertising firm, right? So what about Nike? Cyclical or defensive? Are they consumer discretionary or consumer staples? Somewhat discretionary. You don't have to buy shoes, right? Um, and once you hit 40, you'll never buy another pair of shoes the rest of your life anyway. I mean, look at your grandparents' tennis shoes. They bought them back in the 70s. So yeah, so this is kind of a younger generation kind of thing. Are they going to buy their shoes at Payless shoes or something? So discretionary, but this isn't high discretionary. So you're talking more in the 1.2 range, not in the 1.5 range. Netflix. Some people might argue it's more staple than discretionary because if you go in a recession, what are you going to do? You're going to stop going out. You're going to stop going to the movies. Netflix is cheap. It's cheap entertainment. It's a lot cheaper than movies, isn't it? How much can you watch on Netflix? What you're paying them versus what you can at the movie theater. I haven't been to the movie theater in years. I'm sure tickets are higher than $10 now. It's ridiculous. So you could argue, but probably above one, but probably not radically above one. Schlumberger, a lot of time energy companies can be lower. Schlumberger is an energy equipment company, so it's a little bit different. They're selling high expensive durable goods. So you can argue that Snap-on, they're selling mechanical tools mainly to construction people. That sounds like a high beta, doesn't it? Philip Morris, cigarettes, what are they? High beta, low beta, what would you think? What do smokers do in a recession? They smoke more, right? This is probably the ultimate kind of low beta firm. Verizon used to be very low beta. Now it's a little more debatable because Verizon's doing more advertising and TV kind of stuff. Pulte Group, that one's pretty obvious. You build houses. What is a house building? Is that high beta, low beta? Pretty high beta. Semiconductors are usually higher betas. Newmont, that's a tricky one. You'd have to see which mineral they're digging up. If they're digging up gold, you could probably argue them being lower beta, but I don't think they do gold. I think they do copper. I can't remember. You all know what Newmont does. It's been a while since I've looked at them. Yeah, they explore gold. They do copper, silver, zinc, and lead. I would think of them as a higher beta, but the fact that they dig up gold, you think of gold as being does well in a crisis. So you could certainly argue that. Let's see what their latest beta was. 0.53. So that does argue. So yeah, if you do Newmont, you think a materials company is high beta, but a material company that produces gold, then you got that. Okay, well, wait, gold tends to be a anti-cyclical kind of goes against the cycle. So some of them are tougher, but that's the kind of thing you're looking at. Levi is going to be almost the same as Nike. So, if you do the same frame you did for the paper, that's fine. That works. So you start with that. What is my company? Is it cyclical, defensive, or somewhere in between? So grocery stores are going to be defensive. Discount stores like Walmart, Target, Costco are going to be defensive. Consumer discretionary, travel, leisure, heavy industry are going to be cyclical. So think about that. Some firms are somewhat in between, like McDonald's might be close to one. Target is probably below one, but not much. So it just depends on the business. Once you do that, then you have two topics you got to talk about related to leverage: operating leverage and financial leverage. You covered operating leverage in 3013, but just to remind you, operating leverage is a measure of the fixed costs in the firm's cost structure. So the higher your fixed cost, the more risky the firm is, the higher the beta, the lower the fixed costs, the lower the risk of the firm, the lower the beta. So what could you talk about in paper 3 on operating leverage? Well, the most obvious thing is their workers. Are their workers hourly workers? Or are they salaried? Are they unionized? Hourly workers are going to be more variable. You can let them go when you don't need them. That's going to give you lower fixed costs, lower beta. Salaried workers and unionized workers are going to be higher costs, higher fixed costs, higher betas. So, you got a firm like NVIDIA, all of their employees are salaried, high paid professionals. So that's going to somewhat give them some fixed costs because they're not going to lay those workers off in recession. The last thing they want to do is lay off their workers and then have them go start a new firm to compete with them, right? Their workers, they want to beg them to stay at NVIDIA. So you look at that. Other things you can look at is if they have a high research and development budget that they have to spend every year, like a pharmaceutical, that can be a fixed cost that you have. If they have a lot of property, plant, and equipment, like Intel, that has these big fabrication plants, that's going to give them a huge fixed cost of depreciation. So you want some discussion here on the type of cost structure that your firm has. Think about what they do. Now you have to be really, really careful. So McDonald's, what kind of employees does McDonald's have? Hourly or salary? I'm not talking about a McDonald's. Yeah, why would you say salary? We talked about this in this class? I can't remember. Why would you say salaries at McDonald's? What does McDonald's do? They don't own many McDonald's, do they? They own very, very few. Who owns McDonald's? The franchisors and the franchisees. So McDonald's doesn't have hourly workers. They have salary workers at the franchise sites. So they are more fixed costs. They're getting, revenue. Their revenue is going to be the royalties. That's going to go up and down with the revenue of the firm, but their costs can be pretty fixed. So you might be surprised that McDonald's has more operating leverage than you might think. A Starbucks has a lot of variable costs because Starbucks doesn't franchise; they own their restaurants, so they have a lot of variable costs. So some firms are almost impossible to think about. Disney has high paid people producing movies, and they have low paid hourly workers working at their theme parks, and they have contract workers doing acts on their cruise lines. It's hard to really come up with that. So sometimes you really have to think through the firm. So don't just assume. What I'm going to help you out on this one is I'm going to give you a file that you can use. There's a file out there on Canvas. I'll show you how to use this chart in the video. I forget where I put it. It's in here somewhere. Oh, here it is. So I put the chart in here so you'll see it in the video. So this is my theory on operating leverage. If a firm has high fixed costs, the standard deviation of their margins, their net margin is going to be very high. Because if you think of it, you have high fixed costs. When your revenues change, your net income is going to change a bunch. Because if your revenues go up 2%, but your costs don't change, your net income is going to go up 10, 20%. If your revenues go down 2% and you have all these fixed costs, your net income is going to drop dramatically. So my measure of operating leverage is how volatile are their margins. This is not their margin. This is the standard deviation of their margin. All right. So we just mentioned Newport. So what you do here is you go find your company. Newmount, Newmount Corp. They're on line 1842. Brings them in. And you look at their margins, they're incredibly volatile. The standard deviation of a typical stock's margin is 7.5%. Newmount's is almost 18%. That implies really, really high fixed costs. That would make sense for a mining firm like this, right? They got a lot of land and equipment. They probably have unionized workers. They got to pay them no matter what. They probably have to pay huge royalties, huge amounts to governments. It's probably even bribes they have to do sometimes. So that implies really, really high fixed costs. Firm like Costco, which was already up there, 655. What kind of workers does Costco have? 655. So hourly workers, but they pay them really, really well, but they're hourly workers. They don't have a lot of fixed costs because their stores are their warehouses, unlike Walmart has a separate warehouse. Costco is extremely streamlined. And look at the standard deviation of their margins. That looks pretty low, doesn't it? Hardly even moves. And you can see it in the data. Just look at the data. Here's their net margins. 3%, 3%, 3%, 3%, 3%, 3%, 3%, 3, 2.5, 3, 3, 3, 3, 3, 3, 3, 3, 3. Anyone want to guess? Anyone want to forecast Costco's margin next 5 years? Any guess? Thinking 3 might be it. So pretty easy firm to forecast. Walmart's not radically different than that. Not as stable, but definitely very, very stable. So, Costco was 0.26% standard deviation. Walmart is 0.73, 1/10 of what the market is. Very, very low volatility. Now, I put gross margin in here. You can leave gross margin out. The reason I do gross margin is that to me is somewhat of an indication of price elasticity. How sensitive are their customers to price changes? You remember price, inelastic price sensitivity? Y'all do that in economics. Remember elastic pricing? So if it's inelastic, like a cigarette company, if tobacco prices go up, they raise their prices, their customers keep buying what they've always bought, their margins stay stable, no problem. If it's high elasticity, you raise your prices 2%, your volumes drop 10%, you're gonna see a lot of volatility in gross margins. So I'm going to argue that firms that have low standard deviation of gross margins have very inelastic demand for their product. They can raise and lower their prices as they need to as their cost of goods change. Firms with high standard deviation of gross margin probably have very elastic demands for their products. Their customers are very sensitive to price. If I did a Starbucks, how sensitive do you think Starbucks customers are to the price of coffee? Or is that an addiction too? It looks pretty high, doesn't it? Their gross margins are pretty volatile. What does it cost? I've never bought coffee at Starbucks. What is the coffee at Starbucks? One of those ventis, what are it's called? Is that $8 or something? $7? That's a lot for coffee. What is it at McDonald's? $2. What is it at HEB per cup? So is Starbucks a high beta company? Probably not a 1.6, 1.7, or they 1.1. Do you think Starbucks would notice a recession? If we went into a pretty decent recession, you think Starbucks would notice less traffic in their stores? Probably so. And their customers seem to be a little bit price sensitive because their gross margins are very sensitive. Their net margins are not as volatile, so they're somehow controlling that below the line. Maybe that's how they deal with their workers or something. I don't know where their workers go in the gross margin, but it gives you some insights. You can leave gross margin completely out of your paper, but I give it to you just as an interesting point of comparison. Luke?
What's the difference between the gross and net margin?
Well, gross margin is your revenues minus cost of goods sold. Your net margin is usually, I use EBITDA or EBIT. It's your earnings after all expenses before taxes and interest, and that divided by revenue. So anytime you see the margin, you're dividing by revenue. So gross margin is your revenues minus cost of goods sold. That's your gross margin in dollars. You divide that by revenue, you get your gross margin as percent. Net margin is your earnings for interest and taxes divided by revenue. That's your bottom line. So those are the two margins. Some people talk about operating margin. A lot of time operating margin is the same as EBITDA margin. There's not a huge difference in those two numbers. But operating margin's a little tricky. If you listen to Business Breakdown, which I highly recommend, they contrast Netflix to Spotify. So Netflix has started producing their own shows, which means Netflix has massive fixed costs. What has Netflix done to their operating margin, operating leverage? They've greatly increased it. Spotify does a lot of licensing. We just put our podcasts out on Spotify. So they're not paying me anything. They probably never pay me anything. But eventually they may have to. We get really popular, like we get 4 views instead of 3 views, maybe they have to start paying me money. They have to license it out. That costs them money, but it moves up and down with their revenues. As subscribers come on, they have to pay licenses more. So it's very variable cost. So Spotify has very low operating leverage. Netflix has very high operating leverage. Does that mean it's bad for Netflix and good for Spotify? Well, not really. It depends. It's bad for risk. That certainly makes Netflix riskier, gives them a higher beta. But which would you want if your revenues are growing? If your revenues are growing, you want a lot of operating leverage because your revenues grow and your costs don't grow. Your net income is going to mushroom. So right now, Spotify, as fast as they're growing, I bet they wish they have some fixed costs. So it depends where you are in the cycle. Yeah, if you're a fast-growing company, you love operating leverage, and business breakdowns talk about that. Fast-growing companies, they have fixed costs. They're going to see their net income just skyrocket, but they're going to be much more volatile. So high beta, but high growth. So don't think of operating leverage as always being negative. It has the positive aspect when you're growing. You love it because your revenues are just going to offset those fixed costs, and you're going to see massive, massive earnings growth. You think about it, Uber. What do you think Uber's costs are? High fixed costs or low fixed costs? What's their biggest cost? Isn't that their drivers, don't you think? That sounds like a very variable cost, doesn't it? They don't pay their drivers' salaries, do they? It's per ride. A lot of variable costs. That means Uber has a struggle as they grow and grow and grow and grow. Their net incomes aren't growing all that fast because most of that's just going through their drivers. At some point, they're going to need to have fixed costs. Why would Uber like to go to autonomous vehicles? Because then that's a fixed cost. They don't have to pay you don't have to pay an autonomous vehicle more for driving more. It's the same cost. You have to pay a little more for electricity or gasoline, but so it just depends. Uber would love to have high operating leverage right now, but they don't. So it makes it really hard for them to get out of that losing place. So, but it is definitely bad for beta. High operating leverage is going to give you a higher beta, period. Financial leverage is the easiest one, is how much debt does the firm have? All you got to do here is go to the chart and just look at it. You can't do this for Starbucks. If you want to do Starbucks, so if you have a firm that just says value, that means your firm has negative net worth. I can do the same thing with McDonald's. Line 1679. Doesn't have a debt to equity because they don't have any equity. Their net worth is negative. If you have a firm that you're doing, you've done all your work, you get to this point, you see a value there. Don't think you have to start all over. I redid this chart using not debt to equity, but debt to assets for those firms that have a value there. Okay. So let me know if you have a value. I'll put that file out on our canvas. And so if you're using McDonald's or Starbucks, you can use that file instead. Let's look at a firm like Kroger's, 1512. So look at Kroger's. Is Kroger's a high beta firm or low beta firm, just from their cyclical or defensive? What do y'all think? What is Kroger? Grocery store. Is that high beta or low beta? Very low beta. But what offsets that? They have very low operating leverage, right? Very, very low standard deviation of margins. That makes sense. A lot of salaried employees. Most of their customers, they know if coffee prices are up, they're going to pay more for coffee. It's pretty straightforward. I don't know many people that go on to H-E-B and banana prices are up and they're all mad at H-E-B. Oh man, they're ripping me off. They know if there's some banana crisis somewhere in the world, that banana price. Right now, Ghana's having big crisis. They're a major producer of chocolate. Chocolate prices are up. Are people protesting in front of H-E-B because chocolate prices are higher? No. So grocery stores tend to get away with raising their prices when their cost of goods sold go up. But what's the one negative on beta for Kroger? It's their debt. Their debt is enormous. They have a 155% debt to equity when the average stock is 62%. Now, what does that mean for Kroger? So you say, okay, this is a low beta firm, maybe 0.5. they're staple, consumer staple. They have low operating leverage. Oh, but wait, they have high debt. Well, you're not going to take them from 0.5 to 1.2. You might take them from 0.5 to 0.7, from 0.5 to 0.6. So the high debt's going to push them up closer to 1, but probably is not going to shoot them above 1. All right, so it's a relative kind of thing, but you will penalize them for their high debt. Now, there are some firms that are a little bit unique. You take a firm like Duke Energy, 849. You say, wow, look at that high debt. But that's okay for them. Why is it okay? Because they're utilities. Utilities always have high debt. Why? Because their earnings are so stable, they can afford to have high debt. They have a lot of collateral. So if you have a Duke, what will help you in this paper, and I highly recommend it, if you do a firm like Duke, bring in some of their competitors so you can show that the whole industry has high debt. With Kroger, you'll notice that Kroger stands out versus everybody else. So something that give you a lot of bonus points on this paper is do a bar chart where you show Kroger versus Walmart versus Albertsons or whatever, and show that Kroger really has high debt. Or if you do a utility, you do Duke and say, well, they have high debt, but you also do 3 other utilities and they all have high debt. You can say, okay, it's probably not an issue. This is the industry just has high debt. So technology firms tend to have very low debt. Utilities tend to have high debt. So it's more than just comparing it to the stock market. You have to also know the industry as well. So with Kroger's, it stands out that their debt's really high. With Duke, it's pretty obvious they're in line with the rest of their industry. So there are some nuances of this that you can really make your paper much stronger. It's also going to help you on LinkedIn. If you put this paper on LinkedIn, those kind of conversations it's what gets you jobs, that kind of nuance of understanding that you can't just look at the debt, the equity when you're looking at utility. Some firms are a little strange. Apple, it looks like they have high debt, but they don't. All right. Why don't they? Because they have, I mean, true, they got $200 billion in debt, but they got $250 billion in cash. I mean, so that's the other part of this. I use gross debt here. Some people use net debt where they take debt minus cash. I don't like to do that because then you get negative numbers. So if you do Apple, I don't know if any of y'all want to do Apple. If you do Apple, this number is completely fictitious. And you can see it in their financials. So they got $85 billion in debt on the long end, another 20 billion. So they've got a lot of debt. But then you come up to their assets, you got $65 billion and another 90, you have $150 billion. So their debt and their cash are almost identical. So it's just you throw it out. So be aware of this when you're looking at companies like using this. This does not tell the entire story. So just be cautious. It works for most companies, but there's a few. So if you bring up a tech company like Google or Apple or Microsoft, and it looks like they have high debt, go and look at their cash. The problem with looking at their cash is their cash isn't sitting in cash. There's some of their cash, 65 billion, but they also hold their cash in investments. That just means instead of putting their money in T-bills, they bought some 1-year treasuries, 2-year treasuries. So that goes in, but that's still part of their cash. So you can see they have $160 billion in cash and $150 billion in debt, or $100 billion in debt. So, it's a little bit exaggerated. That's where you get really good bonus points on the paper for making those nuances. All right. Any questions on leverage? So you need to get that file put in your company. That does mean the company you pick needs to be in that file. So you might load that file first and look at your company to make sure you're getting data and that everything looks okay before you pick your company, because you might have a problem. And the last one is rolling beta. I've shown you that before, haven't I? We did that in class, didn't we? Everybody remember? Anybody remember? No? I think we did it in here. You'll see it on the video. So there's a couple ways you could do it. I created a file. I can't remember if I gave it to this class, but I will give it to y'all. I will put it out there. Yeah, it's this file right here. You can do the rolling beta. If you watch the video, I have a video that shows you how to do this. But you have to be sitting at a Bloomberg machine to do this one. But this is the cool way of doing it. I may have shown y'all this before. I need to start writing down what I did in which class because all three classes converging here. So you change the ticker and it brings in the stock price, brings in the stock market. You can change the start date. The nice thing about this is once you get your beta set up, following the video, you can do your chart. But then if you want to say, hey, I want to compare my company to another company, all you got to do is change the ticker and you automatically have the beta for another company, just like that. The approach I showed, I remember doing this in class because I actually shared our last class with somebody else. If you do what I showed you in class using Yahoo Finance, that's much, much slower because you have to do one company at a time. You have to bring it, copy it in. So if you haven't used Bloomberg, you've got to use Bloomberg before you graduate. You've got to get Bloomberg on your resume. The easiest way to do that is Bloomberg Market Concepts. So if you haven't done that, I do Bloomberg Market Concepts. Just get it on your resume. If you haven't done it yet, do it over to rent or break. You don't have to be on the Bloomberg machine to do it. You can do it from home. I do recommend you do it from the lab so that you can watch Bloomberg as you're doing it. But get that. But here's another way to use Bloomberg. The advantage here is if you watch the Bloomberg Market Concepts, you're just using the Bloomberg itself, the actual software. This is using the Bloomberg Excel add-in, which is a whole other part of Bloomberg. So we've been learning that in our dashboard team meetings. We're learning how to bring stuff in just like that off of Bloomberg, make things faster. It really does slow things down to have to go to Yahoo Finance all the time, especially the way they've changed their website. So I would encourage you to get a Bloomberg account. We have had trouble with this formula right here. I don't know why it wasn't working. It looks like it's working now, but if it's not working, you might have to redo it. I'm just using the concatenate formula. You just have to have the ticker and then US equity. So that's what it's looking for. And it looks like it's working, but it wasn't working the last time someone loaded the file. It won't work here because I have this Bloomberg function in there that won't work on this machine, but will work. Someone just asked me if I wanted Bloomberg anywhere, and I said no. Maybe I should tell him yes. I have to rethink that so I could actually use Bloomberg in class. Wouldn't that be pretty cool if I could actually use Bloomberg in class? We could do a lot of really powerful. So I may have to rethink. I may have to call John and say, hey, you know what? I changed my mind. I'm going to email him right after this class. All right. So the advantage of here is you can do a lot more. So it is actually quite powerful to have a chart. We're doing Costco to do Costco, Target, and Walmart on the same chart. So you can see if your firm's beta is in line with the industry or does it look unusual for some reason. That's really powerful. That's a lot easier to do with this spreadsheet than it is to do off of Yahoo Finance. So I'm not going to do the rolling beta here, but those are your 4 steps. You then, on your paper 3, you need to summarize those 4 steps and give me your final beta. What are you going to use? I wouldn't go below 0.4. I wouldn't go above 3, somewhere in that range. But have it, justify it. I might disagree with you, but as long as you're logical and you're consistent, I might use a 1 for McDonald's. You might use a 1.2. I might use a 0.6 for Kroger's. You might use a 0.5. I doubt someone's going to come in here with a 1.4 for Kroger's. That would be really bizarre, really unusual. But, just like we saw with Newmont, yeah, I would probably use a higher beta for them, but you can see their actual historical beta has been much lower. That one's debatable. So that one, you could probably have a range between 0.6 and 1.2, depending on your view of gold. So this is a big part of paper 3. It'd probably take up a couple of pages worth of paper 3. And then we get into the actual valuation models. I'm going to save this for the video. So I'll put it in the video, but the models I'm requiring you to use, there are just two of them, the dividend discount model and the H model, just those two models. I've used to use more than that, but those are the ones I'm requiring you to use. The dividend discount model, you should know from memory. You should have this one. Every finance major knows this formula, but I'll remind you just in case. It's dividend 0 times 1 plus your growth rate divided by your KE minus your growth rate. Real simple formula. It's known as a perpetual growth annuity. What does that mean? It's the dividends can go out for all of eternity at a constant growth rate. So it's perpetual, goes on forever. It's growing at a constant rate, and it's an annuity. Just keep paying you that amount at a growth rate all the way through eternity. Perpetual growth annuity. And a perpetual growth annuity is your cash flow divided by your rate minus your growth. It's just a real simple formula. I know you've heard this as the Gordon growth model. I don't know who Gordon is and why he'd get credit for something that is so pretty basic. So I don't know, he's the first one to use it for stocks or what. I should look him up and see where so he's getting credit for something that he didn't invent. Someone else discovered it. I think, I don't know, maybe he's the first one to figure out the perpetual growth annuity. So I'll have to look him up and see why he's so famous. But the dividend discount model, very, very simple model. The problem is you only get, there's two problems with it. There's only one growth rate. So what does that mean? If your firm's growing really fast right now, but if ultimately it's going to grow like a normal firm, you're going to have to somehow average those out to get a growth rate. So if your firm's growing 20% now, but ultimately it's going to grow 5%, you don't want to use 5%. You don't want to use 20%, but you might use 5.3% to get you closer to that kind of 20. So your one growth rate is all you get. The other problem is it assumes dividends equal free cash flow. So free cash flow is really what you're supposed to do. If you take Dr. Katapeckham, which I highly recommend, he's the free cash flow king. He's going to teach you all about free cash flow. That's the true value of a firm. A free cash flow. What is the firm producing that they can pay dividends, buy back stock, pay down debt? Very few firms are paying out their free cash flow in dividends. And so what I recommend is use free cash flow per share in place of dividends. And I'll show you that on the video, but for free cash flow per share, my simple formula is cash from operations minus CapEx. Real simple formula. Divided by shares outstanding. You'll see that in the video and you'll see how to work that. I'm going to cover some of this class in the video because you can easily watch that. In the video, you'll see me do this, and for Walmart, it gives you a much, much better valuation. If you use dividends, the valuation is way too low. If you use free cash flow, you get a valuation that looks pretty reasonable. If you're doing NVIDIA, they're paying like 4 cents in dividends. You can't use dividends. You'll get such a ridiculous valuation for NVIDIA. You'd have to use free cash flow. So it's pretty easy. Free cash flow, you get that off of you get both of these numbers off the cash flow statement. Very, very straightforward. You go to the cash flow statement. There's their cash from operations, 118 billion. You go under investing cash flows, and you find this net PP&E. They only have $9 billion in CapEx. So 118 billion minus 9 billion. That's going to be their free cash flow. And then you go to the income statement and you get their fully diluted shares, 15,812,000,000, and that's going to give you free cash flow per share. It's real straightforward, very easy calculation to do. Is it accurate? It's real close to what Bloomberg uses. In fact, I think that's exactly what Bloomberg does for their free cash flow. It won't match what you do in Katapakham's class. So when you take his class, you'll get a more sophisticated answer. But I don't want to cover that in this class because you'll cover it in his class. And it takes too long to cover that topic because there's so many different ways to calculate it. So this is a simple approach. It'll give you a decent number. And for a lot of companies, if you're doing Alphabet, they don't pay dividends, so you have no choice but to use that approach because otherwise you won't have a number to use. Right? Then the H model is the dividend discount model all over again. But you get to have more than one growth period. So we're going to do this plus dividend 0 times something called H times a short-term growth minus your long-term growth. That's how the H model works. All the H model does is it adds this little middle section to allow you to have a different growth period today versus your ultimate growth period. So you have a firm that's growing 20% today, so use 20% here, but ultimately every firm's going to grow like the economy, so about 5%. So you have 20 minus 5, you have dividend 0, and the H is the half-life to get from short-term to long-term growth. So if you think it's going to take you 10 years to go from 20% growth to 5% growth, your H is half of that and is whatever it is. So 20 years, your H is going to be 10. So your H is half of the number of years to get from short-term to long-term growth. For the exam, you have to know these two formulas. For life, you got to know these two formulas, so it doesn't matter. You might as well learn them now if you don't already know them. So valuation formulas, this is the anatomy of finance. We just know these formulas. If I were a finance major, I'd be irately upset if a finance professor gave me a formula sheet. You should argue, not when the other students are around, but you should argue that they shouldn't be using formula sheets. All right, don't do it with other students because they'll get really, really mad. But you should not be using formula sheets. This is what you have to know this stuff off the top of your head. Really, really important stuff. Now, I say dividend 0 and I say dividend 0. What are you actually going to use there? Free cash flow 0, which is what the number I just showed you. It's that historical free cash flow. All right. So you'll see this in the video. I'll walk you through it. So once you do that, you have your valuation and your recommendation. Recommendation versus the current price. I've had students write this paper and not tell me what the current price is. You always say the current price. So you do your valuation versus the current price, and you're going to say buy, hold, or sell. What is your recommendation? I think this stock's worth $100. I can currently buy it for $60. I'm putting a buy on this. I think this stock's worth $100. It's currently trading for $98. I put a hold on this. I think this stock's worth $100. It's currently trading for $140. I'm going to put a sell on this stock. That's your final recommendation, right? If you go through this paper, you're doing exactly what people do on the job with some simplifying places along the way. But if you get into this paper 3 and 4, and in your first job as a security analyst, you could do what you did on paper 3 and 4 and be in perfectly good shape. They wouldn't look at you funny. You'd be perfectly fine. They'd want you to get a little more in depth in studying the company. But as far as what you do in all the valuations, where your higher workload is going to be coming up with these numbers, these growth numbers, that's where you're going to spend all that extra time. But the basic stuff you're going to do to value the firm is what you're doing in papers 3 and 4. There's nothing radically different that you're going to do. So if you do paper 3 and 4, you're set up to be a security analyst. You can do it. Now, my security analysis class goes much more in depth, but it's not that we're doing different stuff. We're just diving much deeper into it.
What's the difference between paper 3 and 4?
3 is the discount rate. So all you're doing in paper 3 is come up with KE. 4 is the valuation. You're coming up with your growth rates, your free cash flow, and getting your valuation, and you're making a recommendation. you're going to turn it in as one paper. The only reason is papers 3 and 4 is I'm making it worth twice as much as the other papers because it's twice as much work. But it's really one paper. So you're just going to turn in one paper, right? I'll give you grades for the 2 pieces, but you'll get a grade overall that would be in there. All right. Other questions on this? You'll trust me, when you see the video, it'll make more sense because what I do in the video is I'll walk you through step by step in Excel. And then what your paper is take everything you did in Excel and put it into words into the paper, and then copy some of these charts in and put them into the paper. So once you get the Excel done, you're about 90% done. Then all you can do is write about it. Real important, we'll talk about it when we get close to the paper. Make sure you show all of your math in your paper, because I have students that say, my dividend discount model price is $72, and I have no clue how they got that number. I want to see the numbers, their dividend, their growth rate, their KE, because some students have typos or they miscalculated something and I have no idea where it went wrong. And there's no way I can grade it if I can't get the value you had. So that's the easiest part, is plugging the numbers in the formula. And some students don't get credit for that because I can't figure out where they got the numbers. So you need to show me how you got the calculations. One thing absolutely for sure that you know beyond any doubt is that your growth rate, long-term growth rate, must be lower than your KE. Has to be. Don't be that one student out of 40 that gives me a valuation that's a negative number. I know it seems shocking that students turn in the paper and they say, I think NVIDIA is worth negative $47. No, you don't. If you own NVIDIA stock and someone says, I'll buy the stock from you, you give me $47 and the stock, and you say yes to that question, there's something wrong with you. All right? Because what's the most you can lose on a stock? What's the least it can be worth? 0. It can't be worth a negative number. All right? Why did I get a negative number? Because the growth rate was like 8% and their KE was 6%. Does that mean the valuation's negative? No, that's a flaw in the formula. A firm whose growth rate is greater than their discount rate is worth infinity. It's not worth negative. That's a flaw in the formula. It's worth infinity. I might show you that in class one day. So that's an error. But I have students that say, yeah, I got negative 100, I got negative $42. It's currently trading like a straight face. They're writing their paper. It's like sometimes you get so into the weeds, you don't step back and say, wow, that's ridiculous. That doesn't make sense. All right. So don't get so blinded by what you're doing, typing away, to step back and say, does that make sense? Always ask, does that even make sense? Always ask that question. I'm not saying these students aren't smart, they aren't capable. They just are worn out in the semester and they stop thinking. And you can never stop thinking in finance. Always ask, does that even make sense? All right. All right. So next class, what we'll do is we're going to talk about relative value analysis. Very, very important topic. It's one of the questions on the exam. This is the question on the exam that's the most missed, and I have no clue why. In my opinion, this is the easiest question on the exam, and it is always the worst question on the exam. I'm adamant this class is going to be different, but I'm not going to bet on it. But anyway. All right, I'll see y'all next class.